This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Howdy, everybody. Thanks for tuning in. It's me, Mike. I'm back. I know it's been a handful of weeks since I've recorded a video, but certainly appreciate Owen and others stepping in and keeping these fun things going. But hey, there's a lot to talk about it, so I wanted to record a video, certainly entertaining things when it comes to current events of lately. One of the things I wanted to jump on first, though, was the exciting, I know Owen talked about it last week, but the debut of SpaceX. The world's largest IPO, the potential of the world's largest company, all of these exciting things. I think Owen did a great job explaining some of the visual challenges we were looking at, because certainly we were getting a lot of phone calls from clients on, hey, is this an investment? Should I buy some? And our attitude was, well, let's slow down a little bit. You have a company that was so, we'll say, unprofitable that they rolled multiple companies into it in order to make it look more credible for the giant IPO. And even when you rolled the three companies together, that's SpaceX, Starlink, and XAI, when you put all those kiddos together, they still have a negative $5 billion loss. Does it mean they're not going to be profitable someday? No, but we need to be realistic right now. And so how do you do that and then give a company an almost $2 trillion valuation? It was rather shocking. They instantly were the seventh largest company in the world, yet they had negative revenue by comparison to a NVIDIA or someone like that who makes $160 billion net revenue a year. So that's a little wild. It was almost like the idea of, are you going to go pay $1 million for a Honda Civic or something like that? And so what happens? It opens. It's exciting. This is the big moment we've all been waiting for. The hype for years. Investors have been involved in this thing for years, waiting and waiting and waiting. And what do we end up with? I know it's, charts are charts, but you kind of see here at the bottom right here, it opens down here on the left side at $150. Even though the IPO is priced at 135, it opens instantly at 150. And over a couple days, it goes to almost $230. So 20% a day. This is very exciting. Oh my gosh. It now just went from a $1.8 trillion company to like a $2.6 trillion company. Holy guacamole. And now we've entered fun phase number 2, where it's just basically gone straight down. As of this morning, it hit 147. What that means is every single person at that moment who had bought it as a retail investor on the market was at a loss because it opened at 150. So, and to be fair, trading at 156 also means the majority of all people who bought it as a retail investor who would have waited and grabbed it the first day or something like that are very likely now underwater. Now, does this mean that it doesn't turn around tomorrow and go straight up like a missile? Not at all. That's the fun part about speculation investing and all of this stuff. What's happening, though, is there's a lot of moving parts here that overwhelm this stock specifically. The rules were all changed. One of those rules that was changed was that the NASDAQ, the index that traditionally has a company wait 1 year before they can be added to it, changed the rules that said that SpaceX can be added in 15 days. So on July 6th, the NASDAQ will include SpaceX into their index. What that means for SpaceX is all of the ETFs, all of the funds that track the NASDAQ, they will be required to buy SpaceX, the shares. So it's estimated that somewhere probably between $5 and $7 billion of shares will be enforced buying in early July. That in and of itself, once again, could make the price go up, because people are buying more of it. Then you go to phase 2. There's restricted shares. Remember, people were buying hedge funds, private equity funds, employees. People have been buying into this for probably 10 or 15 years when it was valued dramatically less, and they've held their money and trapped it here for years. Normally, those restricted shares, it's called a lockup, they tend to open up somewhere between 6 and 12 months. Rules are a little looser on this one too. we have lockups starting at 6 weeks. So as soon as the first earnings come out the first week of August, so somewhere around August 5th, something like 28% of the locked up shares are already available on the open market to be sold. So all those people that bought it 10 years ago, that, you know, they could probably sell this thing for $30 and still be rich at the moment. They're probably going to dump a lot of shares between August and October, which is going to be very challenging in our opinion for the stock. So is this something you want to own? I don't know. It seems really expensive. Is it something cool and exciting? Absolutely. Is it something people will talk about for a long time? Sure. Is this like buying Amazon in the 90s? Maybe. But it seems pretty early. And I think that the most important thing here from being reasonable is being patient. And if you're patient and wait probably closer to the end of the year to let all of those restricted shares come onto the open market, see what the open market does with them, get through a couple quarterly earnings, then you might wake up one day and say, hey, you know what? The valuation seems a little more reasonable. There's probably a good entry point there on the idea that we think that in 10, 15, 20 years, this is going to become the world's largest company and be super incredible, which is probably true. But once again, it doesn't mean you want to be too early to the party, right? It's kind of cool to be a little late. And at the moment, if you got all hyped on this thing here in the first 10 days, it's already, we'll say, not doing what people had hoped for. I mean, put this in perspective. A year ago, Newsmax had their IPO. They opened at $10, and in 2 days, they went to $220. Think of the multiple return on that. This thing went up a little bit, cool, fair enough. And then it just petered right back out. So no biggie. Just wanted to give everyone an update on that because honestly, I'm fielding a lot of calls and people are asking for a lot of feedback on this. So just wanted to touch base. The other fun thing that I thought was a little giggly that I wanted to touch on is Trump accounts. So the government in the last tax bill created what are called Trump accounts. So a Trump account is a new tax deferred account for newborn children. So anyone born between 2025 and 2028, you as a parent. So I'm saying this because most of my clients are older, but your grandparents. So you can go tell your kids to do this. But if you have that grandchild that was born in 2025 to 2028, you'll go file a little form with the government and they'll open up a retirement account for that little person and they'll put $1,000 in it. And that $1,000 can be left alone and then the kid can become the owner of it at 18. But also it has a $5,000 a year contribution limit. And so you can also choose as mom and dad, as a grandparent, as whoever, to put up to $5,000 in it. The reason that this is funny is this is a national thing. It's in every state. Most of the states are cool about it. And then you get to California, because California is all kinds of fun and loves to just make everything wonky. So California has decided to not conform with federal law on this, even though this is a literal net benefit for all of our little children who have no savings and no money. California has said that they're not going to allow it to be tax deferred on the state level like it is federally. And so California expects you to somehow keep track of it individually every year. And even though you haven't sold anything, you haven't done anything, they want you to count the gains in it as taxable income on your California return. So as usual, California has found a fascinating way to wonky up something that might have been a nice little thing for the little people of this world. And then, so sorry, I know I'm bouncing around. These are kind of random topics, but these are just things that were so interesting to me lately. Now we get to the hot topic. Holy guacamole, the Fed meeting last week. We had Kevin Warsh, our new Fed president, come in. He has his first meeting ever, and he grabs that rug and he pulls it out from under the whole world. And most people hated it. I loved it. I thought it was awesome. So what happened? So President Warsh comes out and he says, look, you know what? People are way too dependent on the Federal Reserve. We're way too dependent on the government. It doesn't really aid the idea of free market policy. We don't have free markets in the United States, really. We pretend that we do through capitalism, but we really have a government-regulated, government-controlled free market. The market is way more dependent on what the Federal Reserve is doing than hyper-focused on earnings of companies and the true fundamentals that should be driving markets. And so President Warsh said that one of the things that he's going to do is he's going to remove forward guidance. And so that's one of the things that has been become more and more and more outspoken over the years. I've been doing this 22 years. We never talked hardly about forward guidance when I first started doing this. And now it was like the core thing. Oh my gosh, next month's when Powell talks, at least we'll see what they're thinking in the next few months here, really. And the idea is he doesn't want the market to lead changes. If the market thinks rates are going up, if markets think rates are going down in the future, then they're going to price things and front run stuff. He wants the market to work more naturally, more organically, and what the Fed to do, kind of take a secondary role. I think that that's a huge positive because it has bothered me for a while that the Federal Reserve is almost like this rock star crew throwing a rock concert every 6 weeks where everybody stops talking, everyone gathers around the stage so we can hear what the Fed's doing. That's not what the focus should be. In any case, he kind of changes some of the policies. He also says he's hiring a bunch of committees to try to figure out how to reevaluate and rejigger the idea of what inflation reads really are. The main thing that I think he was focusing on is the way the government figures out inflation is they do surveys. And so it's like the month ends and I don't know, they pick up the phone and they start calling people and say, hey, do you think prices went up? It's this very archaic, old school way of doing things. He would like to use high frequency data to evaluate where inflation is going. And it's amazing. So I'm on the CME Fed Watch tool here, which is something that I've showed many of you or these videos over the years, tons of it. And so this little blue bar on the left side, the 3.5 level, that's where Fed funds rate are. And so what I'm on is I'm on the July meeting and it's saying, hey, at the moment, there's a 65% that there's going to be no rate change, that the rates will stay the same in July. There's a 34% they're going up a quarter point. You're like, wait a second. Now we're talking about rate increases. So the day that he spoke, the market crashed that day, and then it recovered the next day because people were digesting the confusing chaos because markets are very calm. Markets love the routine, right? And so when they removed the guidance, it's almost like turning the headlights off on the car. Now that the stock market and all the analysts and all of the traders can't see where the Fed's going, they can't front run that data into how they trade. If I go to the September meeting, there's a 30% chance rates stay the same and a 70% chance they've increased. So in this visualization, while everyone's working off of how the Powell ran the Federal Reserve and the survey data and all of those things, because inflation came in hot recently, all of the sudden, everybody's thinking there's a rate increase coming. But one of the biggest drivers in that 4% inflation rate we got was oil over the last few months. Oil had skyrocketed. Now all of the sudden oil is kind of not collapsing, but it's kind of collapsing, right? It was but $100, it seems like an hour ago. Here we go. Just, a month ago, it was at 112 and now it's down to 70. So that's a massive rollover mathematically in what drives inflation. And so if we're doing that old school surveying of the Federal Reserve, are we picking up those changes quick enough? And I think one of the things that he's looking at with high frequency data, I've showed this to you before, is here's a third-party website called Trueflation. I've been on it before. And what this is a private company, and they use, I don't know what it is, something like 4,000 individual high frequency data points every day to calculate where current inflation is. So it's way more technical than the old school Federal Reserve process. On top of that, they say it's 99.5% correlated to where the government's version of CPI actually ends up. So it's shockingly accurate to where things are going to be in the future. And this is crazy. You're all looking at the screen. It says that current inflation is really at 1.8%. You can kind of see the lower part right below it, probably here where it says BLS reported 4.2. So we have a massive disparity right now between what real high frequency data is saying and what the government is saying about the inflation read. And so it's kind of amazing. Now, inflation was going up. You can kind of see it here on the right side of the chart. Inflation was going up with the oil, and then it suddenly rolled over pretty dramatically because it was recalculating that oil shock going from 112 back to $70. And so there's a tale of two cities here. And so it's going to be very interesting to see what the Fed does, how they come up with new calculations. If they lean towards this high frequency calculations, I'm suspicious that we're all going to be surprised, and there's probably rate cuts coming this year versus rate increases. So holy guacamole, there's a lot going on. but that's all right. It's all part of the fun. But that's kind of all I had. I just want to touch on those few things for you today. It's the summer. We get into the summer doldrums of trading. I still think the market's just going to be kind of pouty and hanging out for a while. I think that the second half of the year, really in the fourth quarter, the market will cycle up hard. It will not shock me at all to see the S&P around 8,000. And there's just a lot going on. You have the new Fed coming in. You have incredible earnings coming out. I mean, holy cow, the earnings have been growing so well. It has been awesome to see. Manufacturing has stabilized. The labor market has stabilized. The stinky thing we have is that inflation number. But once again, I think it's a little misleading because it's pulling off of trailing data and it's not representing how oil just fell 30 or 40%. So in any case, lots to think about, lots to look at. If you guys have any questions, never hesitate to reach out to us. That's why I'm here, Tana, Owen, Andrew, Deborah, Andrea, Kathy, whoever the person is, we're all here to help you guys out. So please reach out. Certainly visit our website, thelindgroup.com, if you got any questions, and hope everyone has a great week. I gotta play.